Good morning, everybody. This is Jim and level 2 of the CFA program and the learning module on financial statement modeling. Let me just remind you quickly that we just covered the topic on financial statement analysis, in which the Institute really asks us to think like accountants. Remember, we looked at balance sheets and income statements, and then we had a really cool reading on evaluating the quality of financial statements. But now, moving into the corporate issuers topic, the Institute is asking us to think like we want to think, like good financial analysts. So we're going to make decisions in these next handful of learning modules on dividends and share repurchases. We'll look at mergers and acquisitions. And then, of course, in this learning module, we'll take a look at financial statement modeling. Now, let me go ahead and just remind you that at level 2, we do this in a little bit in the context of the policy statement, but we're really preparing for level 3 where everything is in the context of the policy statement. So I want you to think of these LOSs as really an example of the following relationship. Let's suppose that I'm Jim and I come to you with a bunch of money, and I throw a bunch of money on your desk as the good wealth manager, and I say, look, I have all this money, I don't have any idea what to do with it. Help me out. So we craft this policy statement together. Of course, you take the lead on it as a good financial analyst. But essentially what you're going to do is you're going to look at the entire economy, and then you're going to look at all of the pockets inside of that economy. Maybe those pockets are based on industries or sector or geography. And then inside of those pockets, you're going to go ahead and find the best firms, the best financial assets to invest a bunch of money. So notice we have to do lots of comparing and evaluating and demonstrating. And, there's a good one in there, judging and explaining. I want to go back here to the very bottom LOS. Notice that the Institute really changes its kind of ideas on how to present behavioral finance, both at level 1 and level 2, and then, of course, at level 3. And so here the Institute is injecting behavioral factors in how they influence our top-down, bottom-up, and hybrid approaches if you look at that very first LOS. So this is really a big picture learning module. We'll be way more specific and we'll do lots of math in the upcoming learning modules. But for now, we're really going to just talk about things like how do we take a particular decision? For example, identifying the best firm in the financial institutions industry for a particular client and all of the inputs that go into that particular decision. So you had your accounting hat on in the previous topic, so take that off and throw it away. Well, don't throw it away, just put it over there where you can pick it up later. And then put your financial analyst hat on here. And this is probably good news for many of you, maybe it's not so good news for some of you, is that we're going to rely on lots of the material that we covered in level 1 and level 2 on both macro and microeconomics. Of course, this learning module starts with a sentence and a paragraph that reads something like, you know what, whenever we're trying to figure stuff out, we need to start at the revenue level, whether it's at the macro revenue level or the micro revenue level. And we can do this from different sources. And so look at those diamond points there, geographic distribution, an industry or a business segment or a particular product line. And so you know this from level 1, top-down approach, bottom-up approach, and then you kind of combine the two of them into a hybrid approach because, after all, top-down has some advantages and disadvantages, bottom-up has some advantages and disadvantages, and so that hybrid approach is kind of taking an amalgam of those two and trying to get rid of the disadvantages of each. My take on this, and I don't really teach a class that we call security analysis. That's another finance professor that does this. But I have lots of students who take my investments class and that particular class at the same time. And so, after class, we sit around, talk about, the differences and the complements of each class. And I always say to them, I say, look, this other professor, he's teaching you really how to make these decisions and then find the best avenue. And so if you go back to these LOSs here, judging and explaining, compare top-down, bottom-up, and hybrid, that sounds like a really, really good exam question in which you're given, a bunch of stuff in the question stem, maybe listing some advantages and disadvantages, and say, hey, what's the best approach for this particular client? All right, top down, this is super easy. What we're starting with is with the macro economy. So we need to think about all of the stuff that we learned under macro topics. And we'll probably start with GDP, right? We take the P times Q, price times quantity, for every product line in the entire economy, and that adds up to GDP. And of course, for developed countries, that's going to be in the trillions of dollars. So you start at that big level and you say something like, I think the GDP for this particular economy is going to grow by, let's just pick a number and say 5%. So then what happens is that you take a look at each of these pockets. Remember, I called those pockets just a little bit ago. And those pockets could be based on an industry, sector. They could be geographically related, and they could be markets for specific product lines. So the goal then is to say, okay, if the overall economy increases by 10%, let's look at the summation of all of the individual variables that contribute to the overall economy. Now let's just go ahead and do it by industry. There might be one industry that grows by 8%. There might be one industry that grows by 2%. There might be one industry that grows by a minus 4%. All right, so what you do is you try to find those pockets, those industries that are going to have better than average GDP growth. And then over on the final arrow point, you say, okay, this is the highest performing expected industry for this coming year. Well, let's go ahead and find the best firms. And that's pretty much the top-down approach in a super nutshell in just a handful of minutes. But of course, if you were actually doing this top-down approach, it would take you longer than just a few minutes. So let's get back to what I was saying just a moment ago about GDP. What are we going to do? We're going to first forecast nominal GDP growth rate. What did I say there? 5%. Then we're going to estimate industry and company growth rates in relative to that long-term GDP growth rate. And we're going to identify those industries that have superior growth prospects. Now, of course, embedded in all of this conversation is some measure of inflation. Now, I'm going to go ahead and take off my CFA hat, and I'm just going to put on my regular PhD hat and tell you guys what I've told my students in, let's say the last semester or two. When it comes to inflation, I have no idea what's going on, right? In the United States, we've had, around 8% rate of inflation. In other countries, it's been 12 or 14%. And so I really don't know how to give you great advice when you have such high rates of inflation. Now, remember that the CFA Institute is very proud of the fact that it doesn't really test you on current events. But clearly, with this increase in inflation globally, the Institute is probably going to emphasize higher inflation rates in its question. And so the idea then is for us, when we're answering these questions, is to be super sensitive to high rates of inflation and how it's going to impact industry growth. I mean, clearly it would be great if we said something like, oh, inflation is going to be 10%, therefore our revenues are going to grow by 10%, and our cash flows are going to grow by 10%. But let me go ahead and scratch my head and say, wait a minute, it probably doesn't work that way because the consumers out there, they are probably not going to have an increase of 10% in their income. And even if they do, they're probably going to be super sensitive about spending all that money today, thinking that, that future income might not grow at that fast rate. That's why in that third box, we have forecast real GDP and then relate that to inflation. All right, so let's get back to our conversation on market growth and market share. So let's go ahead to my example. GDP grows by 5%, but a specific industry, let's just suppose it's the financial services industry, is going to grow by 10%. So we forecast that based on industry factors, right? And then what we need to do is say, all right, inside of that industry, let me just make up a company, Jim's derivative securities firm, what is Jim going to be able to capture of that extra growth? And that's why in that purple box we have current and anticipated market share. So in order to evaluate Jim's anticipated market share, you're going to have to evaluate Jim, right? You're going to have to look at me and say, okay, how smart is Jim? Is he smart enough to hire lots and lots of smart people around him? Does he have the technology? Does he have the capacity? Does he have the intellect? Does he have all those kinds of things? From all of that, what we can do is we can forecast Jim's derivative securities revenues. Remember, that's going to essentially be P times Q. Now, in the financial services industry, and you know this just as well as I do, it's kind of hard to do P times Q when you're trading options and futures contracts, but clearly there are ways to do this. So look at that gray box at the bottom there, projected revenue growth, projected market share, and projected sales of a given product line. So you multiply those two. Now, this LOS simply asks us to compare, so you might be prepared to do a little bit of math comparing company A and company B. Now, the bottom-up approach, of course, and I do this regularly, we're just going to turn this upside down. We're going to start at the individual company level or the individual product line level. I always give you guys examples of Milton Hershey. What we could do is start at, the entire income statement for Milton Hershey, the top of it, and look at the revenues for all of its product lines. Or we can take a look at, Hershey Kisses or Hershey chocolate bars or licorice or icebreakers or whatever it is. So we begin at the company level. So this is where we have to use our expertise on evaluating the board of directors, evaluating the executive leadership team, evaluating the capital structure on the right-hand side of the balance sheet, evaluating the P times Q, the market power. I say this to you guys regularly, what's the goal of the business? The goal of the business is to maximize shareholder wealth. One way to do that is to develop branded product lines. So we're talking about all that stuff inside of an individual company. Well, then we do it for Hershey Foods, and we do it for Mars, and we do it for all these other different chocolate companies, and then we project that all the way out to the industry level. And then we do this for each different industry, and then we all of a sudden get a GDP growth rate. So the focus here on the bottom-up approach is way more intense at the individual company or product line level than it is in the top-down approach at the macro level. I mean, the change in GDP is kind of like the end product in the bottom-up approach. Now, you should know from watching my previous recordings that I love to link LOSs from one learning module to another. All right, so look at what we have there in 1, 2, and 3. Time series. So this is a great time to ask the question, let's go ahead and use time series data for an individual company, and let's go ahead and try to estimate growth rates for that particular company. Oh, time series, that's so much fun. Or we could do return on capital, and there's just a quick example for you under number 2. Or we could take a look at capacity-based measures. I remember when I was going through my PhD program, and even afterwards in my early days of teaching, I would have conversations with marketing students and then marketing professors. And they always seem to come back to Walmart, and I remember them saying something like, Sam Walton generates more revenue in every one of his stores every quarter. And I'm thinking, is that really true? Every quarter, Sam Walton makes more money at every store. And, maybe back in the 1990s during that expanding economy, that was true, but clearly it probably hasn't been true over the last, 2 or 3 decades. But focus your attention on same store growth and then relate that to new stores. Now, the Walmart example might not be a good one because I'm pretty sure there's a Walmart in everywhere in the United States, although I'm guessing that's not true in some less populated states. Now, what did I say earlier? What we want to do is we want to take the good things and we want to take the bad things and we want to combine those into a hybrid approach. And this is probably the most widely used, mostly because it combines the advantages of each of these. So think about it this way. If you're using the top-down approach, you're starting with the macroeconomy. If you're using the bottom-up approach, you start with the individual company. But if you're using this hybrid approach, what you're doing is you're just kind of, oh man, can I get my muscles out and squeeze those two together so you can pinpoint those implicit errors that occur when you have this single approach. Think about top down, always do. Think about it like, snowflakes falling down. Bottom up, thinking about like, a fire with the smoke rising to the sky. And what you're trying to do is avoid those mistakes. All right, let's go ahead and focus on the income statement. I said this earlier and this is absolutely true, that any kind of forecast ought to start with the income statement because everything else flows from that. So let's do a P times Q. How are we going to take a look at the income statement? So top-down approach, general inflation levels and industry-specific costs. This makes perfect sense. When you use the bottom-up approach, what you're going to do is you're going to look at inflation for individual product lines and what that does to margins and growth rates. I mean, clearly the level of inflation in the chocolate market for Milton Hershey is going to be way different than inflation in the beer market for Budweiser. Geez, they probably use some common input, but there's no milk that goes into beer, right? Maybe there's a little sugar. There's probably no chocolate, although when my father was alive, he used to drink Schmidt's Bock beer, and he would say it tastes exactly like a chocolate bar. So maybe I don't know what I'm talking about. But you get the point here with that bottom-up approach. Make sure when you think about inflation and all of those costs, you go down the left-hand side of the income statement. And then, of course, that hybrid approach combines overall inflation levels with how that, and I'm going to use a word here that I don't really like, but how that overall inflation level trickles down to the individual inflations in each industry and in each particular product line. Now, the Institute then goes on to distinguish, of course, between variable costs and fixed costs. When I was an undergraduate student, I used to think those fixed costs were fixed, meaning that they were fixed, meaning that they never changed. And I was always thinking, these costs, they change. And so my professors would say things like, well, there's overhead, electricity and air conditioning, there's fixed investment, there's all different types of things. And then in my accounting classes, we learned about different depreciation methods, and we learned about different methods to evaluate inventory. And I'm thinking, I don't really know what's fixed and what's variable. And so the Institute does a really good job of figuring out what I did later on in my undergraduate days. So even though fixed costs are not just fixed, like in my 20-year-old puny brain, fixed meant that they were fixed. But if you think about them as not directly related to revenues, then it makes way more sense. So total capacity growth, investments in property, plant, and equipment are those fixed cost relationships. Variable costs, on the other hand, are directly related to revenue. And so they can be modeled as a percent of revenue, or they can be done as individual kinds of units. How about skipping down to those bottom teardrop points? Is the company benefiting from economies of scale? Now, if you go to the actual learning module, you'll see that the Institute gives you a couple of different thoughts about this. But the main thought, as I see it, is, all right, you have this company A over here that's doing this much stuff. And then you have company B over here that's doing this much stuff, right? And so you have to go down when you look at the average cost per unit. So notice those economies of scale definition that we have down there at the bottom. Make sure, now remember that when we had our economics conversation, they're all different types of costs, right? So focus here on average cost per unit falls as revenue increases. What are some factors that lead to economies of scale? This goes back to what I was saying earlier, right? Branding. If you have a branded product line, you're probably going to have better bargaining power. You're probably going to have a lower cost of capital. You're probably going to have lower marketing expenses, at least on the per unit level. Look down at the bottom light red box we have. Gross and operating margins are positively correlated with sales level. In an industry that enjoys economies of scale. So this is an interesting box down there. We'll have some other interesting boxes here in the next couple of slides. So this is probably the way the Institute is going to test your ability to, well, look at the LOS, evaluate whether economies of scale are present. And so it sounds to me like this is a great way to have company A and company B and give you a bunch of stuff and say, are economies of scale present or more present in which of those firms? Of course, you can do this with cost of goods sold. Look in the gray box. There are equations that you probably learned back in level 1. But because those cost of goods sold, think of what those costs are for Milton Hershey. You got all this stuff that goes into all of these raw materials and commodities inputs. And then you have, just think about it, a big old airplane full of Hershey Kisses. They're the cost of goods sold. Let's suppose that that's 100. We're probably not going to sell them for 1,000, right? That's probably the largest component of that total cost. So look at that embedded arrow point. A small error leads to a large error in forecasted operating profit. Cost of goods sold, of course, are inversely related to gross margin. We learned that back in the previous topic. And there are some other arrow points there that you probably should know. And I bet you know this from your memories of level 1. Look at that last one there. Use competitors' gross margins to cross-check. A great way for the Institute to test this is to give you company A and then over here give you averages for the top 3 or 4 leading competitor firms. Let me call your attention to that third arrow point. Look out for the impact of a company's hedging strategy. Think about Milton Hershey. What are those inputs? Sugar. So what happens to the price of sugar? Maybe the price of sugar goes way up. Maybe the price of sugar goes way down. So does Milton Hershey use a sugar futures contract or some other kind of a derivative to hedge? So this is super cool. I love this linkage between hedging here that we talk about in our derivatives topics and the goal of the business, right? What's the goal of the business? Maximize shareholder wealth. Well, how do we do this is, one way is to lock in a future input cost. So Milton Hershey can lock in the future price of sugar. Southwest Airlines can lock in the future price of its energy. Procter & Gamble can lock in its future price of, I don't know, what does Procter & Gamble, what is that? What goes into shampoo? I don't even know what goes into shampoo. But paper and plastic, so you can use derivatives here. So the use of derivatives really can impact those cost of goods sold by lowering volatility. Boy, that's super important stuff. This is probably the dullest part of the income statement. SG&A, they're probably not too linked to revenues. So what are these? Wages, overhead costs for employees and research. Different components of these are often disclosed, and so you could probably get some subtle or minor relationships here, but I like that last arrow point. This is what the Institute seems to emphasize in the learning module. Benchmark these against competitors. Non-operating costs. So these are probably important for companies like Milton Hershey and Sam Walton and Procter and Gamble, but they're super, super important for firms in the financial industry. Of course, interest income, interest expense, and then taxes and minority interest, unusual charges. We did all that back in our financial statement analysis conversations. What I always tell my students is, take a look at interest income, take a look at interest expense. And for a lot of firms over time, these two things tend sometimes to kind of offset each other. Financing expenses. So this has everything to do with our conversations about Modigliani and Miller on the right-hand side of the balance sheet and achieving an optimal capital structure. And of course, the interest on the debt. The interest expense on the debt determines on the interest rate on the bond issue or any other kinds of financing. Oh boy, let me take a deep breath here and say, all right, we got floating rate debt and we have fixed rate debt. And so we're exposed to interest rate risk. Now, this is not really part of the LOS, but notice that it does say to demonstrate. So you'll have to be aware, fixed or floating rate. You'll have to know about the maturity date of the bond, maybe coupon rates, maybe yield to maturity. But once again, what we learned in that previous topic is, you can find out everything you want and probably even more than you want to know in the notes to the financial statements. All right, how about the last part of the LOS? Take a look at income taxes. So statutory tax rate. So just go to the IRS webpage and you'll see all those different statutory tax rates. But what's probably more important for us as good financial analysts is the effective tax rate. And we can use this looking at historical tax rates or forecasted net income and forecasting what that tax liability will be. And then we can come up with some effective tax rate. And then lastly, we can take a look at the cash tax rate. Now, we did all that stuff there in those previous, 10 or 12 slides on income statement modeling. Let's move over to balance sheet modeling. We do the income statement first, the P times the Q, and then all of our expenses. So we have some kind of net income, right? And so what do we do as good financial accountants? So we take that net income, hopefully it's a net income, we take it and we shove it back over into the equity portion of the balance sheet. What's the goal of the business? Maximize shareholder wealth. How do we do that? We want the equity portion of the balance sheet to swell, right? We want tons and tons of equity. How do we get that? Well, we get it by generating lots and lots of cash flows over on the cash flow statement, which hopefully translates into lots of net income on the income statement. All right, so how do we forecast a company's balance sheet? So there we go, items that flow directly from the income statement. We take the net income and then maybe we pay some dividends and that gives us our retained earnings. So we want that retained earnings section to swell. We can look at some income statement projections. We can take a look at accounts receivable. We can take a look at accounts payable. We can take a look at inventory. So think of that orange box there as the working capital estimates based on the different product lines and our estimates of P times Q, right? Revenues on the income statement. And then, of course, we need to worry about our investment and financing decisions. What's the goal of the business? You guys tired of hearing me say this? Maximize shareholder wealth. How do we do this? We invest in projects that have positive net present values. So that's resulting from investment. Think Milton Hershey. Every time Milton Hershey decides to make Hershey Kisses, that's a positive net present value project because it's a branded product line. But go back, let's say a couple of decades ago when Milton Hershey woke up and said one day, hey, let's start making breath mints and these ice breakers. But this was a risky project. This was a risky product line. And so Milton Hershey had to consider what those forecasts, and the forecast for revenues and margins and operating cash flows was much more volatile for the icebreakers than for Hershey Kiss. In fact, I argue to my students all the time that while the standard deviation of the Hershey Kiss product line is not zero, because you can't ever remove all the risk out there, but it's pretty low. And then let's not forget about the financing decisions. What's the goal of the business? Maximize shareholder wealth. One way we do this is finding an optimal capital structure. So we either need to, move up the slopeward or move up the slopeward in the other direction, whether or not we need more or less debt. And so that optimal capital structure is going to have an impact on our balance sheet modeling. Let's go ahead and talk just briefly about efficiency ratios. And there are tons and tons of these for modeling working capital accounts. And there's just a quick embedded example: revenues of 100,000. We can estimate accounts receivable. The LOS here asks us to describe, but remember back in our financial statement analysis LOSs, we were asked to compute these kinds of things. So I would know these, at least at the elementary level. Bottom up, we can use historical efficiency ratios. Top down, if we project the entire economy, then we can trickle down. Boy, there's another time I don't like to use that word, trickle down to what those efficiency ratios are going to be. I'm going to go ahead and say this again. Hopefully you guys are welcoming this. If we use these historical efficiency ratios, we can always use time series to help us. Now, what about capital expenditures? This is what I was saying earlier. We can maintain our machinery and equipment and technology, or we can expand by investing in new product lines. And of course, look at that second gray box there, growth capital expenditures. That doesn't mean that's not limited to just investment in new product lines, but it can also mean investment in mergers and acquisitions and joint ventures and all that other stuff. We'll learn about that in one of these future learning modules. And of course, those capital expenditures, this is what I was saying in that previous slide, future capital structure. So we need to look at all of the leverage ratios that we talked about in those previous learning modules. So this is pretty much a summary of what I have been talking about over the last, 30 minutes or so. So this is probably a good idea if you're to get your camera out, take a picture of this slide as kind of a summary of what we've been talking about. We're just kind of sliding through forecasting revenues, then go ahead and look at expenses, then financing costs, and then non-stuff. There's our pro forma income statement. And we do the same thing, but we do it over on the income statement. So what I'm interested in helping you guys prepare for on the exam is take a look at the very bottom. In bold, we have these valuation metrics. So as good financial analysts, what we're trying to do is we're trying to figure out if this particular company fits into our client's risk return objectives. And really the only way we can do that is by looking at the, purple box over on the top right and a blue box over on the bottom right. All right, here's a couple of slides on behavioral issues. Let me just remind you that the Institute is perfectly aware that the founders of modern portfolio theory, Modigliani and Miller, Harry Markowitz, William Sharpe, they relied on lots and lots of assumptions, and some of those assumptions were homogeneous expectations, where everybody out there has the same information set and everybody out there has the same brain capacity. And that brain capacity allows all of us to process all of the information, old information, and then new information in the same way, so that when we show up on the floor of the New York Stock Exchange, we all have the same mindset. But of course, starting in the late 1980s, there was this link between psychology and behavioral economics, and it really exploded into the field of finance. So now we have this behavioral finance. And so the question now is, and this is super cool that the Institute is doing this here at level 2, by introducing these behavioral issues and how they impact our top-down approach and bottom-up approach and all of our pro forma income statement and balance sheet construction. So let me just quickly remind you, there are in general 2 mistakes that investors and financial analysts make. Mistakes up here in the brain, we call those cognitive errors. Mistakes down here in the heart or soul, however you want to think about it, we call those emotional biases. And so notice what we have here, just 2 slides on these. And these are great exam questions. You know, the Institute can give you a paragraph and it says something like, okay, this is what we're doing. This is what the client is doing. This is what the analyst is doing. Identify the behavioral factors that has led to a bad decision or something like that. And then notice the second part of this LOS, recommend remedial actions for analyst biases. And, you know, my general answer to the recommend remedial action is for the analyst to stop making mistakes of the brain and stop letting the heart or soul be involved in the decision-making process. All right, so overconfidence in forecasting. Let me give you just a quick example. Years and years ago, there was an academic study done in which these professors asked the Fortune 500 executives to rate themselves based on their knowledge of the other chief executive officers that are out there. And so the average was like 90% or 92%. So all of the Fortune 500 companies, each of these executives, top executives, they can't be in the 90th percentile. So this is really overconfidence at its best. When the analyst has unwarranted faith in his or her abilities, and of course, the overconfidence bias is greater for those financial analysts who have had more recent success. You know, so let's suppose that I have, within a half a penny, I have accurately estimated Milton Hershey's earnings per share each of the last 20 quarters or whatever I said earlier, right? Well, I'm just going to start thinking to myself, you know what? I'm pretty good at this. And there's nothing that you guys can tell me. So what am I going to do? I'm going to probably make some mistakes because I just think I'm overconfident. Maybe 5 years ago, I worked really, really hard. And each time I worked less and less and less hard to come up with this estimate. Maybe the next estimate, I'm not going to do any work. I'm just going to say, you know what? I was really smart back then. I'm really smart now. All right, so overconfidence there. So how do you remedy this? Well, what you need to do is you need to record your forecast and you need to record the actual earnings per share or whatever the output variable is. And you need to do this over time. And you need to compute a standard deviation over time. And if that standard deviation is increasing, well, then you're less and less accurate. And so recommend remedial actions for overconfidence is probably just, let's be aware that we're not perfect. How's that sound? How about illusion of control? I love this one here. You kind of overestimate your ability. This is true for executives who work at a company and they say, you know what, I work at a company. I'm going to go ahead and work really hard and therefore my stock price is going to go up. And of course, we know that there are systematic factors and there are unsystematic factors that influence stock price. So this is really an illusion of control. So how do we remedy this? Well, the way we remedy this is by doing good due diligence and finding variables that are relevant and modeling those variables. Of course, this goes back to all of our cross-sectional regressions and time series regressions and all that good stuff that we learned in quantitative methods. Conservatism bias. This is a bias that sounds like the following. Are you ready? That, hey, I did all this work on Milton Hershey and I'm going to ignore all of this new information out here because I'm pretty sure that all this stuff is going to hold true in the future. And so this conservatism bias tends to ignore new information that is negative. And so look at the remedial action down there, regularly reviewing the models and those forecasts. Representativeness, habit of categorizing information based on known classifications and past experiences. Of course, if we're talking about Milton Hershey, what do we know? We know everything about chocolate, and we think, we know something about chocolate. But suppose there's some external factor that comes in that kind of challenges our classification of chocolate. Here's the example I give my students all the time. And they agree that this is a crazy example, but it illustrates this known classifications. Suppose that Milton Hershey one day wakes up and says something like, hey, you know what? I'm going to ground up some cauliflower and I'm going to throw that into a chocolate bar. I'm going to call it the Healthy Chocolate and Cauliflower Bar. Well, how are we going to... Well, let's go back. Top-down approach, bottom-up approach, hybrid approach. How are we going to put together a pro forma income statement and balance sheet? How are we going to do all that? Because this is a new thing. At least I think it's a new thing. I mean, probably no one's going to buy it, but let's suppose that somebody and lots of people would be really interested in eating a cauliflower chocolate bar. Well, you can't really evaluate that new chocolate bar based on comparing it to Hershey Kisses or the Hershey bar. Confirmation bias, here's the example that I give all the time to my students, and they agree. I say something like, look, if you want to bring your laptop up in class and you wanted to go to a business web page and you wanted to know something about inflation, would you type in this particular business website, or would you type in this particular business website? And if you reveal your website, I could probably tell you who you voted for in the last election. So confirmation bias, you really are only listening to people who agree with you, and you ignore those people who don't agree with you. Confirmation bias, you're looking for confirmation of all of your thought process. And you want to say, yeah, you know what, I think like this. And someone else confirms it. They come along and give you a high five and they say, yeah, I think like that too. And now you have two people who are thinking alike, and they're discounting all of the polar discussions that are out there. My solution to the confirmation bias in my life is that I don't read any news sources anymore except for the Wall Street Journal. All right, how about Porter's 5 forces? So what we're going to do is take a pause from our financial accounting stuff, take a pause from our financial analyst stuff, although it's not too much of a pause, and we're going to dive into a management course, the 5 forces. So threat of substitutes, intensity of rivalry, bargaining power, and then threat of new entrants. What I always tell my students, not only when they're writing papers in my class, but especially when they're writing papers in any of their business classes, is to go ahead and approach it from the SWOT analysis, strengths, weaknesses, opportunities, and threats. Now, this is not Porter's 5 forces here, but what you can do is you can augment these 5 forces with that SWOT analysis to get a sense of how competitive a particular company is. So I envision this question on the exam to be one of tables. So you have a table, and you don't have to have all 5 forces here. You could just have 2 or 3, and the Institute could ask you a question on bargaining power of suppliers. And you could say something like, if we're Milton Hershey and we get our milk from the farms all over Pennsylvania, and maybe something's happening in the farms in Virginia and New Jersey and New York and Ohio. Did I get all those states there? West Virginia? Maybe something's happening in the milk industry in those particular states that makes it more costly to import milk from those surrounding states. And so now all of a sudden, all of the farmers in Pennsylvania, they have more bargaining power, and that's going to cut into the margins for Milton Hershey. And you can think of each of your examples, an individual example for each of those 5 forces. Here, let me scratch my head again about inflation and deflation. If inflation is 8%, I'm not sure what you do. But of course, you've got to go ahead and weed through all of the fog of high rates of inflation and what the Fed is doing. Here we have inflation in the United States that's way higher than it ever has been, 7 or 8 or 9%, and yet the Fed is saying that their target rate of inflation is 2 or 3%. So how do you incorporate all of this? Well, I think the Institute gives you, some really good advice, some good practical advice, which is probably likely to show up on the exam. And so here are these really 3 important arrow points. So how is inflation going to impact different industries and different companies? Boy, that sounds like a great question to me. Now, embedded in that is, how is it going to affect the top of the income statement, right? Remember, revenues are P times Q. So how is the P for chocolate impacted? How is the P for medicine impacted? How is the P for any of these different companies? And then how is the P impacted on the left-hand side of the income statement? That's that second arrow point, the costs of the inputs. So the way I would ask this is I would say something like, hey, here is the consumer price index. That relates to the revenues. Here is the producer price index. That relates to the costs of the inputs. Now look at the red bold we have here. Companies that can transfer price increases to their customers. Now, who are those companies that can transfer price increases? Well, those are probably the companies that have branded product lines. And this ties in to what I was saying earlier. So look for stability of profits. That means branded product lines. All right, so how about some factors that influence a company's ability? And you probably know this from reading the Wall Street Journal. Over the last year or so, some companies say something like, you know what, we're gonna be willing to reduce our margins so that we don't have to pass our rising prices over to our customers. And that's probably because there's intense competition in that particular industry. So industry structure, company's pricing strategy and market position. So that has everything to do with branding. But I'm going to go ahead and look at the 2 on the opposite side there of the boxes, price elasticity of demand. I love linking different LOSs in different learning modules. So look for some estimate of a price elasticity of demand for company A and company B, and then try to work your way through which one of these companies is going to have, greater profitability or greater cash flows or whatever that answer that the Institute is looking for. And then, of course, during our economics conversations, we talked about purchasing power parity and interest rate parity. So this is a great way for the Institute to say, okay, here's the interest rate in Canada, here's inflation in Canada, here's interest rate in the United States, and inflation in the United States. And by the way, here's the spot rate of exchange. What happens at the top-down approach at the macro level, and then have that fall down through all the way to the individual company level, to try to come up with some estimate of, the pro forma balance sheet and the income statement. All right, how are we going to reduce the volatility of inputs? Well, I said this earlier. We're going to use forward contracts. We're going to use other kinds of derivatives. Later on in these subsequent learning modules, we're going to talk about mergers and acquisitions. So there's vertical integration and there's access to alternative inputs. So what do we need to be worried about? Currency rates, cost structure. And that's not just input cost structure, but that's also financing cost structure as well. Geographic mix, and then the company strategy there. That makes sense. Technologies, right, reducing the cost of production. Where I live, we have a company that has these giant ovens. It's a bakery. And I've actually gone through a tour here. And these executives, they're so proud of their ovens. They say, oh, my oven here, it's 400 degrees. And then over here, it's only 270 degrees. And then we cool it over here to minus 27 degrees. And, at the end, you have a cracker. And so it's really cool stuff. And they're very proud of their technological advancements. But what we can do as good financial analysts is take a look at how is it possible to reduce those costs. Maybe it doesn't have to be 400 degrees here. Maybe it only has to be 375 degrees here. But in talking to these executives, I can assure you that they probably have the optimal temperature of their ovens. But anyway, what that does is it's going to have an impact on profit margins. It's going to impact sales. And it's going to impact almost everything on the right and left-hand side of the income statement. Now, of course, technology can cannibalize. What are we going to do if we substitute or we have complements or any kind of cannibalization? All right, how about this technological development and its relationship to be able to forecast? So what we're going to do is we're going to start with a base year. We're going to forecast those revenues. We're going to analyze the cost structure. We're going to project costs and expenses, and then we're going to forecast net income. And so embedded in probably each of these boxes there is all of the quantitative method stuff that we talked about, including regression analysis and analysis of variance and time series. Yeah, let's go ahead and get to the end of this learning module by saying something like, we're really trying to figure out short-term stuff, maybe the next quarter, maybe the next year, but what about long-term forecasting? So this is where you get into an argument with economists. What is short-term and what is long-term? I remember when I was an undergraduate, my economics professor said, all costs are variable in the long term. And I thought, that sounds pretty clever. But what is the long term? And the professor really didn't have a great answer. And so we need to figure out what that long-term forecasting is and what's going to come up with what the Institute calls normalized earnings. So what do we know? Earnings goes up and down and down. But if we take a look at long-term forecasting, it's probably, hopefully it's upward sloping, right? If the firm is investing in positive net present value projects. But that normalized earnings is going to give us a sense of what we can expect to get back to if those short-term earnings are falling, right? Remember, we had those conversations about reversion to the mean. All right, so let's take a look at these specific factors. Strategy for which stock is being analyzed over a short-term and long-term horizon. Because remember, what we're trying to do is when we tell our clients, we say, hey, look, Milton Hershey is a great stock, and we think it's going to meet your long-term risk and return objectives inside of your policy statement based on and an inclusion of your constraints. Oh boy, so there's a lot of meat on my previous statement there. What is that investment horizon? So this depends on the client. If you have a client, let's say a couple who comes in and they're 30 or 35 years old, well, then you need to worry about that long-term horizon. If you have a client who comes in and says something like, we're retiring in the next year, we're 65 years old, we expect to die when we're 72 years old, well, then that investment horizon is very different. So factors affecting that investment horizon depend on the client's individual risk and return objectives and all of those constraints. And then, of course, we need to take into consideration not only the cyclicality of the economy, but also the cyclicality of each individual industry and how it relates to company-specific factors. That's why in the next couple of learning modules, we're going to learn about dividends and share repurchases and mergers and acquisitions and joint ventures. And then we can use the Myron-Gordon dividend discount model and any other kind of a present value model to try to figure out value today and to predict values going forward. And that's why in that very last diamond point, we have normalized earnings reflect mid-cycle earnings. So we're going like this, and then we throw that long-term upward slope in there. Think of that as mid-cycle earnings. Yeah, we can do this a couple of ways. Historical multiples based approach. So do you want to use price earnings ratio? Do you want to use cash flow to earnings ratio? I've always been a big proponent of using those, using cash flows rather than net income because they are less able to be manipulated. But what we need to make sure is that we're concerned about, historical multiples based approach relies on the fact that history is going to repeat itself. So think about that. If we believe that history is going to move forward, we need to figure out all of those factors that are going to change history. Oh my gosh, this is such a challenging process. But I promise you, if you listen to all of the recordings and you go ahead and believe what the CFA Institute is trying to teach us, then it's manageable. And of course, we can use the discounted cash flow method. Sources of these such changes. So the Institute calls these inflection points. That's what I was saying here just a moment ago. Economic disruption, think about 2008 financial crisis. Think about the 1929 stock market crash. And, there are thousands of these economic disruptions. But, of course, the classic example is, what we've had over the last several years, the COVID disruption. And those of you who are regular readers of the Wall Street Journal, you'll know that, these editors and these authors in the Wall Street Journal, they have articles in there that sound something like, okay, what comes next? What is past COVID? So economic disruptions, changes in the business cycle. What did we learn back in our economic stage? The business cycle, it does go like this and it's fairly predictable, but what's not predictable is the timing of that. The different stages are predictable, but the timing, that's super interesting. Government regulation, just pick up the Wall Street Journal these days and read about Twitter and misinformation and disinformation. Read about that individual with the three letters with the cryptocurrency. Is the government going to come in and regulate disinformation, regulate cryptocurrency? And then, of course, technology inside of all that. And so that takes us through page 1 and page 2 of all of these learning outcome statements. There's a lot to learn in here. Let me go ahead and summarize this. What we've done for you is provide you with 30 or 35 different slides so that you can now go to this learning module. I want you to go look at the very end, and I want you to, are you ready for this? Maybe you need to lie down for this. There are 91 questions at the end of this learning module. So what we've done is we've prepared you to answer all of those 91. So I think if you paid attention here and you work through those 91 problems and then go look at our mock exams and look at all of our questions, practice, practice, practice. So the simple fact that the Institute has created 91 of these questions for you is a big signal, right? Boom, boom, boom. This is an important learning module. So thanks for watching. Have a great day and good luck studying.